Welcome. We are so glad you've joined us today as we unpack some absolutely crucial source
So
material.
it really is. Thank you for coming back to learn alongside us.
Your time is valuable, and our mission is always to get straight to the insight you need right from the source.
And before we jump in, just a couple of quick but really essential requests.
We want to make sure you never miss an analysis like this one. So if you find this conversation valuable, please hit that like button, share it with someone who needs this knowledge, and of course, subscribe.
And we are only able to keep doing these comprehensive analyses because of the incredible support from you, our listeners. We really encourage you to evaluate our channel memberships. That support is truly what makes this all possible.
It really is.
Yeah.
And, if a specific piece of information today, and trust me, there are some jaw droppers, gives you that aha moment, you can also show your support by using the Super Thanks feature.
We appreciate it. That support genuinely pays for the many cups of coffee we need to get through these dense documents. It certainly does. Okay, so today we're diving straight into what I think is the most consequential report in the entire global tech ecosystem.
I agree. It's the Q4 2025 earnings conference call transcript from Taiwan Semiconductor Manufacturing, TSMC.
And this is so much more than just a finance update. It's really a blueprint, almost a crystal ball for the future of AI, of advanced computing, everything.
Absolutely. I mean, when you look at the commitment they are making, a massive step up in CapEx, it reflects an unprecedented conviction in this whole AI megatrend.
So our mission today is to filter this dense transcript, highlight the crucial numbers, the bold forecasts, and, the surprisingly candid answers they gave to some pretty tough analyst questions.
Let's do it.
Okay, let's unpack this and start with the foundation. Section 1, covering the prepared statement, the Q4 2025 financials, and the full-year recap.
Right.
So kicking off with the performance highlights from CFO Wendell Huang, the quarter was a solid beat across the board, came in slightly ahead of what they guided for.
It did. Revenue was $33.7 billion USD. That's a 1.9% sequential increase, which is, decent, but it was stronger in their local currency, right?
Right, 5.7% in NT dollars. So you see a bit of that currency fluctuation, but the underlying strength is definitely there.
But the real story, the thing that just jumps off the page, is in the profitability, specifically the gross margin.
Oh, absolutely. It increased significantly by 280 basis points sequentially
Yeah.
to land at an astounding 62.3%.
62.3%. I mean, for a manufacturing business of this scale, that is a generational margin. It just highlights their competitive moat.
It really does. And they gave 3 specific reasons for that jump, which are worth digging into.
Okay.
The CFO said it was primarily due to, 1, their cost improvement efforts, 2, a favorable foreign exchange rate, and 3, and this is crucial, a very high capacity utilization rate.
So the fabs were just running full tilt.
Exactly. When those machines are running constantly, the profitability is maximized. And what's more, they didn't just hit their targets, they blew past them.
How much by?
That 62.3% exceeded the high end of their own guidance by 130 basis points. They specifically said they had better than expected cost improvements, and the exchange rate was just a little more favorable than they'd assumed.
A nice little tailwind.
Mm-hmm.
And moving down the income statement, you can see that operational leverage playing out. Operating expenses were what, just 8.4% of revenue?
Yeah, down from 8.9% in Q3, and that's textbook. When you can grow your revenue while the cost of just running the business grows slower, you get that incredible leverage.
So the operating margin went up by 3.4 percentage points, hitting 54%.
Just fantastic execution.
Oh, no.
And for shareholders, the results were robust. Earnings per share hit TWD 19.5, and the return on equity was an outstanding 38.8%.
So peak technological excellence, but also peak financial efficiency.
We got it.
Now, let's look at what they're actually making, because the mix by technology really confirms their dominance at the cutting edge.
Right. So in Q4, advanced technologies, and they define that as 7 nanometer and below, accounted for a massive 77% of their total wafer revenue.
77%. That's a huge number. It really underscores that their business is now overwhelmingly reliant on the most complex chips. How does that break down?
Well, the 3 nanometer family, which is still ramping, already contributed 28% of wafer revenue.
Wow, that's fast.
It is. The 5 nanometer family, which is more mature, was the largest at 35%. And 7 nanometer, the workhorse of the prior generation, was about 14%.
And if you zoom out to the full year, that trend just continues, right?
Relentlessly. For the full year 2025, advanced tech hit 74% of total wafer revenue. That's up from 69% in 2024. This concentration at the leading edge means their average selling price per wafer is just climbing and climbing.
Okay, so let's look at the platform breakdown. Where are all these advanced chips actually going?
High-performance computing, or HPC. It was the undisputed largest segment.
No surprise there.
None at all. HPC accounted for 55% of Q4 revenue and a dominant 58% of their full-year revenue.
And this is a critical insight for you, the listener. HPC is the category that houses all the AI accelerators, the networking chips, the advanced server CPUs.
Right. The fact that it commands nearly 60% of their annual revenue tells you exactly where the center of gravity for TSMC and, arguably the entire tech industry is right now.
So what was second? Smartphone.
Yep, smartphone was second. Came in at 32% of Q4 revenue and 29% for the full year. After that, you have IoT and automotive, each at about 5%.
And the growth drivers for the full year really tell the story.
They do. HPC increased a stunning 48% year over year.
48%.
Smartphone saw an 11% increase, IoT was up 15%, and automotive grew 34%. So while automotive is growing fast, the major structural growth is absolutely coming from AI and HPC.
So wrapping up the full year recap for 2025, the key takeaway seems to be that TSMC is just accelerating past the rest of the industry.
That's right. Full year revenue grew 35.9% in USD terms to reach $122 billion.
And how does that compare to the industry as a whole?
So the overall Foundry 2.0 industry, which is TSMC's term for the whole market, logic, packaging, testing, all of it, it grew 16% year over year.
So TSMC more than doubled the growth rate of their own market. Wait, let's pause on that term for a second. Foundry 2.0. Why do they define the market that way? It's kind of their own jargon.
That's a great question. It's strategic. Foundry 2.0 isn't just about etching transistors on a wafer anymore. It's their way of capturing the entire value chain.
So it includes advanced packaging, like CoWoS.
Exactly. Advanced packaging, testing, mask making, all the high-value services that are absolutely required for modern AI chips. It shows they provide end-to-end solutions, and that helps justify the aggressive CapEx we're about to discuss.
Well, it makes perfect sense, especially given the packaging constraints we keep hearing about. Now let's talk about the money. 2025 CapEx totaled $40.9 billion.
Which is a substantial increase from $29.8 billion in 2024. And the CFO was clear. This was a strategic move to raise their spending in anticipation of the growth that will follow.
CapEx today is future capacity tomorrow.
Precisely. And finally, on shareholder returns, they backed it all up. Dividends increased substantially from 14 TWD per share in 2024 to 18 in 2025.
And they committed to at least 23 TWD per share in 2026. That signals some serious confidence in their future cash flow.
It absolutely does, and that sets the stage perfectly for what comes next. Let's pivot into Section 2, the Q1 2026 guidance and the truly tectonic strategic messages.
Okay, so Q1 2026. It looks like they expect the strong momentum to continue. Revenue forecast is between $34.6 billion and $35.8 billion.
Right, and if you take the midpoint of that, it's a modest 4% sequential increase, which is pretty typical for Q1.
But the year-over-year number is the one to watch.
It is a very strong 38% year-over-year jump. It really demonstrates that accelerating trajectory.
And the margin guidance remains extremely healthy. Gross margin between 63% and 65%. Operating margin between 54% and 56%.
So they're basically saying, we expect to maintain the incredible profitability we just reported, and maybe even slightly exceed it.
There was one other small financial detail, the tax rate.
Yeah, a subtle but important one. Their effective tax rate was 16% in 2025, but for 2026, they're expecting it to be between 17% and 18%. It's a minor headwind, but on this scale, a percentage point or two matters.
Okay, here we go. This is where the conversation turns from just strong performance to absolute long-term commitment. The 2026 CapEx budget.
Let's hear it.
Forecasted to be between $52 billion and $56 billion.
Wait, hold on. $56 billion at the high end. I mean, that is a truly jaw-dropping number. That's larger than the GDP of many small countries.
It's an astronomical commitment. How did they even begin to justify that?
Well, the CFO, Wendell Huang, was very explicit. He said CapEx is always correlated to high growth opportunities in the following years.
Right.
This isn't just maintenance spending.
Right.
It's aggressively supporting customer growth, driven by 5G, AI, and HPC.
Yeah.
They're spending that money now because they see the orders locked in for capacity that will come online in 2028 and 2029.
And you can see that conviction in how they're allocating the money.
Absolutely.
Yeah.
70 to 80% of it is going directly into advanced process technologies, into A16 and whatever's next.
So they're doubling down on the leading edge.
They are. About 10% is for specialty tech, And then 10 to 20% is for advanced packaging, testing, and mask making.
That advanced packaging slice is getting a huge step up in absolute dollars. That seems essential to remove those secondary bottlenecks for AI chips.
It's completely essential. But it's also important to realize this has an immediate impact on future expenses. Depreciation is expected to increase by a high teens percentage in 2026.
And for you listening, let's just clarify that relationship. Depreciation is basically the accounting expense of spreading the cost of that $56 billion factory over its useful life.
Right. So if depreciation is increasing that fast, it means the sheer scale and cost of the equipment they're moving in right now, especially for N2, is just staggering. It's the cost of staying ahead.
Okay, let's shift to the big picture, the long-term outlook this CapEx supports.
So for 2026, the overall Foundry 2.0 industry is forecast to grow 14% year over year. But TSMC expects to dramatically outperform that. They're targeting close to 30% revenue growth in 2026.
30%. That level of confidence just speaks volumes about their backlog and technology lead.
It does. But the real centerpiece, the heart of the whole call, is their long-term forecast for AI.
Already.
So in 2025, AI accelerator revenue was a high teens percentage of their total. Looking ahead, TSMC raised their forecast for AI accelerator revenue, CAGR compound annual growth rate, to approach mid to high 50% for the 5 years from 2024 to 2029.
Mid to high 50s KGR for 5 years. That means that part of their business will grow almost 10 times over during that period.
It's a staggering commitment. They see no deceleration at all. And that forecast is what dictates this whole CapEx strategy.
And driven by that, their overall company revenue growth is expected to be around a 25% CAGR for that same 5-year period.
Right. But achieving that growth while maintaining profitability is the big challenge.
Yeah.
And they detailed a series of what they call puts and takes.
Okay, let's look at the positives first. How do they plan to defend that 56% long-term margin target?
Well, first, they expect overall utilization to increase in 2026. Second, a key milestone. Their N3 gross margin is expected to cross over to the corporate average sometime this year.
Meaning their newest, most expensive tech will finally be as profitable as the rest of the business.
Exactly. And then they're relying on manufacturing excellence, squeezing more out of existing capacity, and flexible capacity support between their major nodes.
But there are also significant takes, the dilutive factors. The first one is overseas expansion.
Right. As they build out in Arizona and Japan, they forecast the dilution from those new fabs will widen from 2-3% in the early stages to 3-4% in the later stages. That's just the cost of geographic diversification.
And the second one?
The initial ramp of the 2-nanometer node, that starts in the second half of this year, and it's expected to dilute the corporate gross margin by 2-3% for the full year. That's standard for a new node, but it's a significant headwind.
But despite all that, they remain committed to that long-term 56% gross margin. And they were clear their pricing will be strategic, not opportunistic.
They focus on earning their value.
Okay, let's get into the operational updates on technology and their global footprint.
Right, starting with the technology roadmap. Dr. Wei gave some key updates.
In Arizona, the momentum seems pretty real. The first fab entered high-volume production in Q4 2024.
Which is a huge milestone. It shows they successfully navigated those initial challenges in a new geography. And Fab 2 has been pulled forward due to strong customer demand.
So construction is done, tool-in starts in 2026, and production is now expected in the second half of 2027.
Right, and they've started construction on Fab 3, they're getting permits for Fab 4, and a fourth advanced packaging fab. This is going to be a gigafab cluster.
And what's really fascinating is that they bought a second large piece of land nearby. Dr. Wei called it a hint of their future plans.
It's a huge hint. They're building a cluster, not just single fabs, because you need that shared infrastructure and operational learning to be profitable overseas.
Turning to the core tech, N2. How's that looking?
Very robust. It successfully entered high-volume production in Q4 of last year at 2 sites in Taiwan, with good yield. They're expecting a fast ramp this year.
And they're not stopping there. They also introduced N2P, an extension.
Yep, with further performance and power benefits scheduled for the second half of this year. This is how they keep customers locked in, continuous innovation.
And then there's the really bleeding-edge stuff, A16.
Featuring superpower rail technology, which is a fundamental change in how power is delivered to the transistor. It's for the most complex HPC products, and it's also on track for volume production in the second half of 2026.
Okay, that concludes the prepared remarks. Massive investments, incredible growth forecasts, but now comes the real test.
The analyst Q&A. This is where the assumptions get scrutinized.
It's time to see how the company defends these bold claims. We're going to run through these questions systematically: the analyst, the query, and the critical response.
First up was Gokul Hariharan from J.P. Morgan. He immediately went for the elephant in the room, the AI bubble.
Right. He asked, given this massive $56 billion capex, is this demand real? How long can this cycle possibly last?
And Dr. Y's response was crucial. He basically laid out the methodology for their confidence. He admitted being very nervous about the capex, knowing a misstep would be a big disaster.
So what did he do?
He said he spent 3 to 4 months talking not just to their immediate customers, but to the customers' customers, the hyperscalers.
So he went straight to the source of the demand.
Exactly. And his conclusion was that their answers were quite satisfied. He saw concrete evidence that AI really helped their businesses and financial returns. He even gave an example of a hyperscaler using AI for social media, which increased their user count.
So it's not a wish, it's validated demand from the end market.
That's the key. And it's why he has such high confidence in that 25% long-term company CAGR.
Okay, Gokul's follow-up was about the U.S. expansion. He wanted to know the principle for future expansion and the timetable for that 30% of advanced capacity in the U.S. goal.
Dr. Wei confirmed they are speeding up expansion in both Arizona and Taiwan because of strong demand from U.S. AI customers. And he made a very strong defense of their Arizona ops.
What did he say?
He said the current fab performance yield, defect density, all of it, is almost equal to Taiwan. That is a huge technical achievement.
It is, but what about the 30% goal?
He added a crucial nuance. He said the most advanced capacity increase is still happening in Taiwan, but they're working hard to narrow the overall capacity gap. That second land purchase was an intentional hint about scaling up the Arizona cluster long term.
Okay, next up was Laura Chen from Citibank. She asked about potential bottlenecks, specifically power and electricity supply for global data centers.
This question got one of the most quotable responses of the call. Dr. Wei said candidly, his first concern is electricity supply in Taiwan.
Right, for their own fabs.
Exactly.
Yeah.
But regarding global data centers, he relayed what he learned from the hyperscalers. They told him they planned for power supply 5 to 6 years ago.
So they were ahead of it.
They were. And the key message they gave back to TSMC was this: silicon from TSMC is the bottleneck.
Wow.
The customers are literally telling them to just focus on solving the wafer supply problem, and they'll handle the power. That shows you how starved the industry is for advanced silicon.
Okay, Laura Chen's second question was about advanced packaging. She wanted to know the 2025 revenue contribution and where the capex is focused.
CFO Wendell Huang took this one. He said advanced packaging was close to 10%, about 8% in 2025.
And for 2026?
Expected to be slightly over 10%, and forecasted to grow faster than the corporate average over the next 5 years. So this segment is accelerating. The investment is going exactly where you'd expect: 3D IC, SoIC, Co-IOS, all of it.
Makes sense. Next, Charlie Chan from Morgan Stanley asked about the non-AI end markets: PC, smartphone, general servers.
Dr. Wei was quick to argue that separating non-AI is getting harder. He said networking and general servers are still growing strong because they're needed for the AI data scale-out.
But what about PC and smartphone units?
He expects unit growth to be very minimal because memory prices are rising. But, and this is TSMC's key insulation, they supply most of the high-end smartphones.
Which are less sensitive to component price increases.
Exactly. So their demand stream is protected.
Okay, Charlie Chan followed up with the big one: Intel foundry competition. Should TSMC be concerned?
Dr. Wei's answer was kind of concise.
What do you say?
No concern. He just expressed high confidence in their own ability, pointing to technology leadership, manufacturing excellence, and customer trust as their key differentiators.
I have to push back on that a little bit. No concern. I mean, Intel is being very aggressive. Isn't this huge $56 billion capex at least partially a competitive response to ensure they stay ahead?
That's a very fair challenge. And you're right. While he might not want to give them rhetorical validation, the actions speak louder than words. The commitment to A16 with superpower rail is a direct response to the needs of HPC customers that Intel is also targeting.
So the competitive pressure is real, even if they won't say it.
It is. The enormous capex is how they maintain that lead and raise the barrier to entry for everyone else.
Okay, next question was from Arthur Lay at Macquarie. He asked about reports that TSMC is exiting the mature 8-inch and 12-inch businesses.
And Dr. White confirmed they are reducing 8-inch and 6-inch capacity. It's just becoming less economic to run those older, smaller fabs.
But he was careful to say they won't abandon their customers, right?
Very careful. He said they will not let customers down. They discuss it with them to optimize resources. So they're rationalizing the older capacity, but not cutting off customers who rely on those mature nodes.
Arthur Lie's second question looked out to 2027, asking about the impact of memory price inflation on consumer demand.
And Dr. Y's response was again very definitive. For TSMC, no impact.
He keeps coming back to that high-end focus.
Consistently, he just reiterated that their customers are in the high-end segments that are less sensitive to that kind of volatility, so they have a very healthy forecast.
Okay, next was Brett Simpson from Areta. He asked a critical, practical question. Since TSMC is supply constrained, will this new capex mean supply and demand are more balanced by 2027?
And Dr. Wei explained the painful reality of fab construction timelines. He said a new fab takes 2 to 3 years to build. So this $56 billion investment contributes almost nothing to supply in 2026 and only a little bit in 2027.
So when does the gap actually narrow?
He said they're really looking at 2028, 2029. That timeline is paramount. In the short term, it's all about productivity improvements in their existing fabs.
Did he address the engineering talent question?
Not directly.
No.
But you can infer from all the comments about the Arizona cluster and scaling up that managing talent across geographies is a huge part of the complexity in the overseas cost dilution.
Okay, Brett Simpson's follow-up was on pricing. Blended wafer ASPs were up about 20% in 2025. Is that the new normal?
Dr. Wei passed this one to the CFO, Wendell Huang, and Mr. Huang offered a crucial clarification.
Which was?
He said that in the last few years, those pricing benefits were just enough to cover inflation, the rising costs of tools, materials, labor.
So it wasn't pure profit capture, it was keeping up with costs.
Exactly. He stressed that their high profitability comes from internal strength, high utilization, manufacturing excellence, not from just hiking prices opportunistically.
Okay, next up, Sunny Lin from UBS asked about the longer life cycles for new nodes. They're seeing higher revenue in year 4 or 5 now, which is new.
Dr. Wei said this is because the market demand for lower power and higher performance is just continuous now, and TSMC's technology provides both.
And he talked about customers coming in waves.
Right. First wave is AI HPC, second is flagship smartphones, third is maybe general servers. That sustains demand for a long time. And their continuous enhancements like N2, then N2P, keeps those nodes valuable for longer.
Sunny Lin then asked about 2mm revenue for 2026 and fundamentally why clients are migrating to N2 when the cost per transistor is going up.
Wendell Wan said N2 will be a bigger node than N3 in dollar terms right from the start. The absolute value is huge, even if the percentage of the total pie is smaller, because the company is so much bigger now.
And Dr. Wei tackled the value question. This is the critical CP value concept.
Right. And to put it simply for you listening, while the cost per transistor has increased, the cost performance value has increased significantly.
So using the car analogy, the engine costs more, but it gets you twice as far on the same fuel, and it's 50% faster. The overall value is way better.
That's a perfect analogy. Customers are willing to pay more for N2 because it gives them the low power and high speed they desperately need. He said their main headache right now is the supply gap, not getting customers to migrate.
Okay, we're almost there. Bruce Luer from Goldman Sachs tried to quantify the AI forecast, asking about the assumptions behind that 50-something% CAGR.
Dr. White gave a very human answer. He said he'd lost track of token growth assumptions. He just focused on the concrete product improvements from his customers, like Hopper to Blackwell to Rubin, which are doubling or tripling performance.
And he used it as a chance to hammer home that main point again.
He did. The bottleneck is still TSMC's wafer supply, not power, not gigawatts.
And Bruce Liu's final question tried to pin them down on a future CapEx number, a 3 years, $200 billion plan.
And the CFO, Wendell Huang, clarified that today's CapEx is for 2028 and 2029 capacity. He stated definitively that CapEx for the next 3 years will be significantly higher than the $101 billion spent in the last 3 years.
But he wouldn't give a specific number like $200 billion.
Nope, he was prudent. But the implication is crystal clear. The scale of investment needed to chase this demand is just accelerating dramatically.
That was an exhaustive and incredibly detailed look inside the company that really dictates the pace of global tech.
It really was.
Okay, let's unpack this. If you only remember 3 things from this entire deep dive, these are the 3 main takeaways.
The first has to be unprecedented AI conviction verified by hyperscalers. They're not guessing. They went to the source and raised their AI to AGR forecast to the mid to high 50%. And they are staking their future on it with that record $56 billion CapEx plan.
The second is the capacity crunch with a defined 2028-2029 horizon. Dr. Wei was clear. Capacity is very tight. And despite the massive investment, that supply gap won't really narrow until 2028 or 2029. That timeline is the single most important operational constraint for the whole industry.
And the third key theme is the shift in technology lifecycle value. The demand for low-power, high-speed performance means that even if the cost per transistor is rising, that CP value, the cost-performance value, is better than ever. This brings in waves of customers and gives their new nodes a longer, more profitable life.
So, what does this all mean for you? If you follow the broader tech landscape, understand that the current AI explosion isn't being constrained by the power grid, at least not yet.
Right. It's constrained by the physical ability to fabricate silicon. And that constraint explains the fierce competition for wafer allocation right now. This call gives us a clear timeline for when that primary bottlenecks might finally start to ease.
The lesson here is that in the world of advanced computing, physical manufacturing execution is king, and TSMC intends to remain the master of that domain.
Thank you for taking this deep exploration with us today. It really illuminates just how high the stakes are in the global semiconductor game.
And just a final provocative thought for you to mull over. TSMC noted the enormous capex for N2 and A16 will dilute margins. If performance gains and power efficiency only come from these ever-increasing multi-billion-dollar investments, what happens to everyone else? The financial barriers to entry are becoming impossibly high, which suggests the gap between TSMC and the rest of the world may only get wider.
A truly challenging thought for the industry. We really appreciate your engagement and the time you spent with us today.
If you found this helpful, please click like, share the video, and subscribe so you can stay tuned for our upcoming content.
And we kindly encourage you to evaluate membership to support our channel and make ongoing videos like this one possible.
Remember, you can also show your support with super thanks if this content was valuable to you today.
We hope you join us next time for another in-depth session. Have a good day.